You know, that bandwidth, Andrew, that bandwidth, they say, well, gold doesn't do well in a rising interest rate environment, and the 10-year treasury rose 40 basis points in less than a month. Okay, normally true. Higher interest is not great for gold, but is it? Because they use that as a convenient argument, but what about the last couple of years when rates went way up and gold was marching to all-time highs? In other words, the gold went up in the face of rising interest rates, and when it's convenient to talk about it, great. When it's not, they ignore it. And the short-sightedness of the West, it will be, I think, will be one of the biggest problems that they will face, because again, we're playing checkers, and the rest of the world, or at least the global South, is playing chess and looking at things on a much larger scale and a much bigger macro picture, where we're looking at things where Fed Chairman Powell says, well, we may actually have to raise rates, and bang, that's the catalyst to smash it again. Well, really? Yeah, well, and that's the narrative that we've had to fight forever, and that's why I focus on the most important thing to me, and that is that whoever is standing for delivery knows where the puck is going. You don't spend billions every month here in the United States, which never happened before, where less than 1% of these contracts ever stood for delivery, unless you know exactly where this ultimately goes. And price is a tool of misdirection. When you have the narrative already controlled by a media that is bought and paid for, it's very easy to control the narrative. And, I found it interesting that the BIS came out and said what they did to the West. And if you look at it maybe the way you and I would have read it, we would have said, wow, they're kind of taking them to the woodshed, saying that the price fell because you guys changed the rules and changed the structure. Anyone else reading that wouldn't quite get it, I don't think. But I looked at it as the first thing that I had seen where someone actually said, you guys created this. You created it on the exchange. You loaded everyone into ETFs and then rebalanced them. At the same time, you raise margin requirements by 300% into that event. Bang, the whole thing collapses. And it just so happened to collapse with 2 circuit breaker glitches where the markets didn't stop, just free fall. We're supposed to believe that. And these are the things that I think are being not lost on the rest of the world. I really do believe that. And I think this is one of the reasons why physical possession is so very, very important, because you're seeing the games that are being played at the highest levels. And you wonder how this all finishes out. But if I had to guess, we've hit the bottom, at least very, very close to it. It seems as though we have. We are very close to the end of the quarter. I would expect the price to turn right back up here, as all the options that were sold, as we've seen many times before, here into the end of the quarter, are undoubtedly going to expire worthless. And the big banks that win all the time win. Now, the only thing that's different this time to me, if I had to guess, is that every time you and I have been talking, I was reading your stuff long before I was commenting on things. You've been someone I've been following for a long time, Andrew, and I will tell you, the only thing that seems different to me this time, it's almost as if this administration says, you've played this game too long, talking to the banks. It's time for you to get on the right side of this, because things are going to change with gold and silver. Things are going to change with strategic metals. Things are going to change with commodities. We can't play this game anymore. And maybe this is the turning event that we've been waiting for. The Economic Times more or less said, look, the banks in the United States have gone net long. Or, net long still could be 11 long and 10 short. But that last drop down, which destroyed this industry in terms of hedging and in terms of refining, and had, I think, effects far past precious metals into the refining industry, which is still blown up. Maybe that was it. Maybe that was the last one. And I know, you can say that a million times until it is the last one, but it just seems that there's a different understanding at that level based upon the deliveries. The deliveries are something I've never seen before. And that, to me, signals a change in what's happening. Where physical is far more important than paper promises. And I think getting on the right side of this, if you're the banks, one of these days they'll make more money to the upside as they did all these years to the downside, especially if the goal in this administration is to bring back manufacturing. The only way to do it is in a massively devalued dollar. And what better way to devalue the dollar than to let gold find its real price discovery? because it is the only neutral reserve asset by which we measure the health of all currencies. So, a lot to think about, Andrew, but it just feels a little bit different that where, they've always been in control and maybe they still are in control, but is it the realization that the control is waning in an environment where physical delivery and physical demand is becoming worth more than the paper promises? I think that's really what's different this time. Every single war that I've been doing this since the Gulf War under President Bush #1, every single time we've gone to war, the price gets clubbed. When you think it shouldn't, it does. You're right. That's an interesting point. And, did you know Jim Sinclair at all?
Yes.
Yeah, and Jim used to call it MOPE, Management of Perception Economics, that they come in to manage the perception. I was going to ask you a question, by the way. Have you seen that story about someone buying 11,000 December 2026 bull spread calls between 15 and 20,000?
I haven't actually, Andy. I haven't seen
Yeah,
it.
so someone bought 11,000 calls, the bull spread between 15 and 20,000 December 2026. The purchasing came after the crash, not before the crash, to me, which is the key point. So some large player used the washout to build a 1.1 million ounce tail risk position at a cost of about $3 million. And it only pays out if metals triple from here, if gold triples from here. Now, to me, it's like he's not betting on gold as much as he's betting on debt and war and inflation and energy choke point and fertilizer and all this stuff that's going on along with the de-dollarization. I know that seems kind of crazy, but it seems like a pretty expensive bet. And if you look, it's all over Twitter. They're talking about it. Someone evidently believes that by the end of the year, gold will be between $15,000 and $20,000, enough to buy 1.1 million ounces worth of gold options, or about a $3 million out of the money gamble. I don't know. I found it interesting to think, does someone know something we don't know? Is someone just pissing away some money? I guess we'll have to see. That bandwidth, Andrew, they say, well, gold doesn't do well in a rising interest rate environment, and the 10-year Treasury rose 40 basis points in less than a month. Okay, normally true. Higher interest is not great for gold, but is it? Because they use that as a convenient argument. But what about the last couple of years when rates went way up and gold was marching to all-time highs? In other words, the gold went up in the face of rising interest rates, and when it's convenient to talk about it, great. When it's not, they ignore it. And the short-sightedness of the West, it will be, I think, will be one of the biggest problems that they will face, because again, we're playing checkers, and the rest of the world, or at least the global South, is playing chess and looking at things on a much larger scale and a much bigger macro picture, where we're looking at things where Fed Chairman Powell says, well, we may actually have to raise rates, and bang, that's the catalyst to smash it again. Well, really? Who cares that rates are at 4.4% in a currency that is losing 10% against the dollar index and being inflated away much more than that? It's just, it's silly is what it is. And it's lack of critical thinking. It's lack of macro thinking. It's people that are very well read, but read the wrong stuff and focus more and more about less and less till they know everything about nothing, instead of looking at a big picture. And the big picture is that the big money out there that knows where the puck is going is shedding paper, where from March 4th to March 11th, the institutional traders sold more S&P futures than any time in history. The big money is leaving the equity markets, and someone with a whole lot of money and a whole lot of information is standing for delivery as the price is getting its teeth kicked in. And the same thing could be said about the PBOC. As the price is getting hammered, they're buying the largest monthly inflow of silver in recorded history. So it's like, these are the things that all you need to focus on, in my opinion. And you do a good job of telling people what's happening, because people are scared. This is why there's an entire school of investment theory, Kondraty and Elliott Wave, that measures the cumulative emotions of the herd. And you speak logically, not emotionally. Take a step back, look at what's happening. That's what I try to do as well, and let people know that, no, this isn't the end. Hang on, trust your gut. The very powerful professional traders will benefit from those emotions, and they're the ones that are standing for delivery, orchestrating the fall, standing for delivery, as the retail public licks their wounds, freaks out, and, starts to believe the conventional narrative, maybe second guessing their own. So I admire the way that you speak very, very matter-of-factly, and that's what's important right now, is to get away from the emotion, look at the fact, look at the reality, look at what the big players are doing, not what the media that is bought and paid for is telling us. That's, to me, if there's anything I hope people take away from what I'm talking about, and I watch everything you put out, if there's anything that I can contribute, it is simply that the emotions need to go on the sidelines for a moment, because nothing's changed. In fact, the fundamentals are worse. Not only that, they talk about rising rates. How are you going to raise rates into an environment where we have the most bonds ever maturing at one time, ever? $10 trillion have to be refinanced this year. How are you going to raise rates into that? You want to blow up the entire system? So there's so many things that are happening that are just not critically thought out to the end. And that's one of the reasons you had this cascade, which to me is not, it's not a tragedy, it's an opportunity. I know that's hard to hear from a guy that sells metals for a living, but I mean it in my soul, as God is my witness. They're frightened, is more than anything, they're frightened. Because this is the same, you had this sustained breakout. People thought maybe it's actually changing, and then it got hammered. They're frightened, and I understand that. Like I said, emotions are very strong, fear being the strongest. And, this is what the professional traders understand very keenly. When you see 30, 40% get wiped out in a very short period of time, it's very frightening. It's very concerning. And unfortunately, most people are not able to separate their intellect from their emotional pull. And so I would say that it's certainly done its job. The price certainly knocked a lot of people back a little bit, and that's why we have these discussions. You said something that I think is the catalyst too, and I think it's very important people catch what you said. You said, in essence, that there has been a temporary dollar bounce, which distorts things. And this is because everything settles in dollars. But it's not real strength, it's just forced selling, in my opinion. And that forced selling has created an environment where people are very afraid because they focus too much on the price and not on the fundamentals. And even the BIS said, this is not fundamentals, it's structural. Like you said, ETFs, levered, and like I said, massive margin increases. And just so people understand what I mean by margin increases, on December 1st, it roughly cost us $15,000 in a margin account to hedge 5,000 ounces of silver. If we have 2 million ounces of silver in our warehouse, like we will, you gotta have 20 million bucks in a margin account sitting there, right? 15 million, just sitting there to hedge your position so you're market neutral with your inventory. Within a month and a half, by mid-January, when the price collapsed, you were at $4,000 to hedge that same amount. They increased margin rates by 300%. And that squeezed everybody, along with the ETFs rebalancing. And that really frightened people this time because, this was the largest silver drop ever. And that's why I took comfort in the BIS coming out and saying, look, y'all, this was structural, not fundamental. Nothing's changed. And I believe that. And that's the message I would like people on this side of the pond and on that side of the pond to understand, is that this is desperation by some players that were trapped. And if I had to guess, this was okayed by the top, basically saying this is your last chance, get on sides and cover your stuff. And is there any coincidence we see JP Morgan covering 3.8 million ounces of silver at the very bottom? I don't know, is it? Maybe it is. Maybe they're just really good at timing. But I would just simply say that, I think people need to not get concerned with the price swing. Easy for me to say, I get it, because focus on what's really happening, focus on what the biggest players in the world are doing, and know that this is right out of their playbook. And the one thing that I would say to people to give them comfort is it really feels like the end of the ability to control the price on a substantive basis is happening because we've squandered the trust of the rest of the world, who is now coordinated, motivated, wealthy, sophisticated. These were countries that were third world for most of our lives that aren't anymore. In fact, they're very sophisticated and very wealthy and very smart, and they are beating us at our own game. So this won't last. And I would say, as you were mentioning, where the options expire here in a day or two, here at the end of the quarter, I would expect to see the prices resume in the manner that we would expect them to in this environment here real soon, hopefully right after the first. But yeah, people are scared, Andrew, and rightfully so. You know, I talk about this kind of stuff happening all the time, and I reference the interview that you did with Bart Chilton, and I reference it in many of the videos I do, because I think it's really important that people understand the stuff that we are talking about is not a conspiracy. It happens. And the head of the CFTC told you that this stuff does happen. And, you know, but I think it was much easier for it to happen when everyone trusted the West and the Western institutions and the Western rule of law and the election process and the immigration process and all of the things that made people around the world say, what the hell's happened to the West? What's happened to those countries? I think once you cross that Rubicon and add into it massive fiscal irresponsibility, creating $1 trillion in debt every 150 days or so, being wickedly monetarily irresponsible as well, and then going around the world with a stick instead of an olive branch and an open hand, I think we are at the end of the rope as it pertains to the privilege we've had with these commodities. And it just feels to me like there's a realization at those levels. And maybe I'm just using wishful thinking, but I don't know. It seems like the act of desperation on this last slam down was unlike anything I've ever seen. And if indeed the banks, like you said, are getting on sides, have the record low short positions, or are neutral, that's something I've never seen before. And if that indeed is what is happening, I guess it does set the stage for the numbers we hear coming out of the big banks, 61 to 6,700. Or how about Michael Hartnett, the chief analyst for Bank of America, sell half of your bonds and put 25% of your assets in metals. Same thing with the chief investment officer for Morgan Stanley. The 60-40 rule that they've used forever, he said, is broken. Sell 50% of your bonds, that's the 40%, put 20% in metals. Or Jeffrey Gundlach, the bond king, 25% in metals is not overweight. At the highest level, you're seeing them talking about this being something where price is not something we should fixate on right now, rather look at it as an opportunity, because if they're right, the second half of this year is going to be fantastic.